such opportunities to the listener's personal and financial situation or the company's, entities, and/or organizations involved. A new home you've dreamt about for years, and there's only one thing standing in your way: getting a loan. Rest assured, United Mortgage Corporation of America is here to help make your dream a reality. Get answers, get results, get the service you deserve. What kind of loan do you have? Call now at 888 Life 980. That's 888-5433-980. Or go to the web at yourrealestatelife.com and take action today.
Welcome to Your Real Estate Life. It's your day in real estate radio. I'm Michael Harris, MLO NMLS 233410, your host, mortgage expert with United Mortgage Corporation of America, NMLS 3189. Now, each week we dive into the numbers, we dive into the market, and we look at the mindset behind building wealth with real estate. Yes, we do. Today, we're tackling what all of you may have been hearing about: a 50-year mortgage. Yes, 50 years. Soon we'll see 100. Oh my gosh. Okay, so we're going to look and compare with the 30, the 15, and explore next week's economic calendar as the government has reopened, but we haven't seen all that data coming in yet, and that's going to make a big difference. We're going to discuss the programs and changes ahead, the Fed, and wrap it up with the Money Max account, which we talk about regularly, your perfect financial GPS. Now that saves you time, it saves you interest, helping you reach your goals most efficiently. Now think of your financial GPS for a moment. It's looking at all your bills, monthly, quarterly, semi-annual, annual, and it's putting all that into play, your homeownership, wealth building, and loan payoff in the most efficient way. Your numbers aren't shared. No one has access to your money. No one's touching it. No one knows your account numbers. We're looking at the 50-year mortgage debate, long-term, smart strategies, and your financial GPS. I'd like to welcome you in our audience on Saturday here on Fox Sports 1590 in Ventura and 94.7 on KVTA. Our Sunday audience here on K-Earth 101 that's joining us at 7 a.m. You could always stream at kvta.com on Saturday, and our Sunday audience on K-Earth 101 as the show goes. But also you can go to our websites, yourrealestatelife.com or unitedforloans.com. When you go there, you can catch our audio. And then we are looking at our YouTube channel at Your Real Estate Life. Now, you can catch parts of our program or all of our program by doing that. I know your time is valuable, but you can have your very own program. 888-543-3980. We inform, we educate, and we want to, most importantly, earn your loan business. We are in the business of closing home loans, but they're home loans that make sense. We got to make sure there's a net tangible benefit, whether you're purchasing, refinancing, going forward, or in reverse, whether it's primary, investment, second home, or commercial, or even construction. We are helping people achieve their financial goals. Now, as we close loans, we want to make sure you're paying those off in the most efficient manner by eliminating interest volume. So we are looking at the things that make a difference. We're looking at the terms and smart strategies and utilizing them properly. Now, as we will on today's program, we're going to look at the calendar, economic events, items that are coming out. We're going to debate these programs, but we're also going to look at proper protection for you and your family. In our third segment, Marisha Charbonnet is going to be joining us. She's going to be talking about setting various things to your trust and maybe why some people even hesitate, because they do. They really, truly do. Now, let's jump to it for a moment. What's in the news? I told you, it's that 50-year mortgage. And there's various things you could do on a 30-year. You can fix it for 2 years, 3 years, 4 years, and you can do all these things and have various numbers, 2, 3, 4, 5 in the front number, buy down rates, do all these things. But a 50-year loan will generally have a slightly higher interest rate than that 30, like the 30 has a slightly higher rate than the 15. So a lot of the comparisons that I'm seeing are comparing a same rate That's an apple to an apple, but you got an orange, maybe even a banana. So when we're looking at the numbers, and even if I use today 6.25, 6.75, 7%, when I look at that differential, even on a loan amount of 500,000, if you took a 30-year loan at 6.75, and that's higher than market today, and I take it there, $3,243 payment, you're going to pay total interest. Again, you're looking at a difference between 1.17 million versus 1.76 million total paid. So that's $667,000 difference. Holy cow. It's a lot of money. It is. And I could run the math with you. I mean, we could look at $300,000 loans at 1,300, and then compare it to a 15, or we can do all these things. But when I see these comparisons and, oh, gee, this loan's terrible, and oh my gosh, and it could lower the monthly payment, make it easier to qualify, but maybe you should not be in the property, but that's something to evaluate. You got to look at all the hidden costs, perhaps, of homeownership, but all the benefits thereof. So we have to look at the cash flow. If your cash flow is better and you have other ways and things that you can do for that reason, or maybe short-term items that you need to do, I talk about on the show, marry the home, date the rate, divorce the debt. So marry the home. We could always change the rate and the program when income stabilizes, or you gather or gain that ability a year or two out, or if rates are a little bit lower and you want to move from that higher rate 50 to a lower rate 30, just as we've always talked about when people move from 30 to 20 or 15. It's about your cash flow. So it's not for everyone, it's for someone, and that someone may not be you. So it's not this bad thing. They're not doing away with a 30. They're giving another choice to get people who are just not quite okay, who feel they're okay, and money-wise and number-wise could be okay, that opportunity. And it shouldn't be an opportunity that you're saying it's a legacy and I'm there for 50 years and I'm not going to touch it. Most people would sell their home or do something within 5 to 7, or even, let's say, even 10 to 12 years. So that loan may or may not be in place that long. Now, there's been talk about using it as a legacy or a family estate where it's assumable and all that. Now, the mortgage industry may have a problem with that and securitizing and pricing it because of the inability to have that consumer maybe back in. So there's all sorts of politics that may be involved with that as well. But we look at all those items. I mean, you have an enormous lifetime interest cost. You have slower equity growth and payoff, and refinancing dependence on long-term debt drag. So you got to make sure you're redeploying that savings somewhere else. And that's where I talk about the Money Max account. But it's really important that you understand items, and it's not doing some creative chemistry lab experiment where you're trying to mix all these ingredients and you hope it works. You need to understand the mix, the recipe, and what you need to do. And it's really understanding where you are and what you're trying to achieve. It's not like, oh, I could do this and then I could, oh. No, we need to understand a plan. So that's what we like to do, and we want to go through it. Now, logically, the 50-year, it's not good or bad. It's just simply a tool. It makes sense for some buyers, but it's not perfect sense for everyone else. The long-term cost is real, but it's a way people can move or refinance, and it does change part of that conversation. There is a window where some people need these items to occur, and that's what this does. When we look at that 12-year timeline, when people will stay in a home and make changes, this is only a tool in the toolbox. It's not replacing something else. I'm Mike Harris, President and CEO of United Mortgage Corporation of America. We will have more right after the break.
Your equity position has started to improve? How about the removal of your private mortgage insurance or mortgage insurance premium and save money today? Call 888-5433-980. What if I told you everything you know is going to be true about money is not? The basic programs will eliminate most of your interest in your life and pay off all your debts, personal or business, even mortgages, in as little as 1/3 to 1/2 the normal time without refinancing and without changing your lifestyle. If you want one more, call 888-547-3980 and request your information today, or email at info@aheadformoney.com. That's info@aheadformoney.com.
Welcome back to Your Real Estate Life. It's Your Day in Real Estate Radio. I'm your trusted guide in real estate and mortgage planning today. I'm Michael Harris, mortgage loan originator 233410 with the NMLS, United Mortgage Corporation of America 3189 NMLS. Call now, 888-543-3980. That's 888-543-3980. Visit us at yourrealestatelife.com or get started at unitedforloans.com. You know, I was talking about the whole item going on with the 50-year mortgage, but there is another item that's occurring as well. And it's already started, or it's starting on Monday, but November 16th, November 16th, Fannie Mae is eliminating the 620 score on qualification. Now, it doesn't mean, oh my God, I can have bad credit. I can get, no, but there's adjustments and fees and costs, and it may or may not be the right solution when we look at that and perhaps FHA financing. But they're also eliminating the 720 rule for second homes, investment properties, and we're going to see how that affects some of the automated approvals. So again, we could have costs, fees, and other items associated to that. So it's going to be a little bit of an adventure starting on Monday, but it's opening up the possibility where you had a 610 score, you had to do this, and you couldn't get that. Now all of a sudden, it opened up a little bit. So we're going to see how that goes. But we're reaching more borrowers in that respect, but we're looking at ineligible credit that perhaps now has a chance. We have some operational significance with the desktop underwriting, as I said, and we have some of the flexibility of looking at second homes, investment property, and others. But let's say you had a 610 credit score with solid income, good reserves, and before the change, I mean, you wouldn't have been considered. Now, all of a sudden, as a Monday, you perhaps are getting that approval. So if you've been going through the process and you had your loan denied, there's a possibility here. So we want to look at those possibilities. Give us a call, 888-543-3980. We're going to look at Fannie Mae's perhaps option and look at their inclusion lending as they're talking and see if it's a smart decision, creditworthiness, and see if it's something you wanted to go do. I'd like to see what we can do to improve your credit score. Now, it's only a number, but if we can improve the credit score, we're saving you money. If I can save you money, that's what we need to do because you're paying more for that money. So give us a call, 888-543-3980. That's 888-543-3980. Something else also that came about was a CFPB, which is going to be running out of money beginning of the year, is proposing removing disparate impact liability from how it enforces Equal Opportunity Credit Act. Now, that's a whole nother avenue. Don't have as much time to go through that, but we're going to be looking at that on disparate impact on intentional discrimination. There's all sorts of avenues there. So we're watching that from a, let's see, as a company owner, I'm looking at it to make sure I'm doing what I'm supposed to be doing. So we're watching that very carefully on special purpose credit programs and other things as it may affect lending. But as I look at what's going on with the government shutdown ending, significant. We're looking at that, spanning 40 days. We finally saw the House pass that after the Senate did theirs. So the shutdown that disrupted, we're trying to get things back in gear and we're trying to get some reports coming out. So we're all waiting for those and different reports are still missing. But as that ramps up, we're going to get a flood of pent-up economic data. We're going to prioritizing September figures that could provide cleaner insights to inflation and growth. But again, it's old data. So as we look at the old data leading to the new data, it's a mess, but we're going to get a lot very quickly. With that said, all of a sudden, we're looking at delays, perhaps, to what's going to go on with the Fed making a move, which saves you money. We're down to 40%? 40% chance that the Fed's going to make a move. So that's not as good as it was. For a while, it was up at 80. Holy cow. So now are we waiting and to do it the next time? I don't know. But now we're really looking at where we are, and the mortgage market's not pricing in the next move. So we're getting kind of stagnated. We're stagnated in the lower sixes. So some loans could be higher depending on loan to value and credit score, sure. But we're trying to get you the best result with the best timing. And if the market does look to move at a later time, we want to make that change, but do it in the right price fashion. So as we're looking at the government opening up, we're keeping our eye open with surprise results that we didn't have before. So the shutdown kind of looks like it estimated between 7 billion and 16 billion a week of lost output due to the furlough workers, delayed payments, and disrupted service. White House counsel says pegs the weekly hit at 15 billion, while congressional budget is saying it's 18 billion. So they're even arguing how much it costs. So, we're looking at permanent economic loss of about 7 to 14 billion. It won't be recoverable even after it opens. It's like you can't just all of a sudden say, hey, I avoided fast food for 30 days and I'm going to eat enough burgers to make up for what I missed. No, it's not going to happen. It's gone. I mean, as much as you want to try, right? It's not going to happen. So it's wiped out effectively that much overall. Now, you kind of balance sheet it out. Oh, gee, but they're paying. And again, I did a lot of traveling in the last few weeks, and I was going all over throughout the United States on some business trips. And of course, the first thing I do is thank those people that are actually working and not getting paid. And they hadn't been getting paid, and now they are. Now, I couldn't go in the control tower if someone was there, but I was able to thank TSA for everything they've done and do at various aspects of my journey, whether it was getting on my flights as far as ticketing and boarding and going through all those areas. Very, very appreciative. So as I look at what's going on now, as we hope to get back to where we are moving forward, we need to catch up. And we're trying to catch up as we head into the holidays. Makes it a little bit more difficult, but we're going to do that. And we have loans that are closing, reverse mortgages, forward mortgages, home equity lines of credit, purchases that are looking to get accepted offers and moving forward. And there's various dynamics to that, whether they're buying a house, a condo, or a townhome. We're looking at HOAs, we're looking at insurance. All these things matter. And that's what I do. I dive into those items with my team and we make sure you are protected and we're getting that done in the most efficient manner. But sometimes you can't rush something in one day. You have to gain the information, cooperation of other parties, the offensive line protecting you against the defense. But sometimes if you rush that offensive line, they stumble and then the defense comes in and now you're a scrambling quarterback. So we want to make sure you're protected. With that said, I'm looking at what the scheduled items are for next week. On Monday, we have inflation trends abroad, which influence U.S. yields with Canadian CPI. We have the minutes coming out actually from Australia, good global results and seeing what's going on. We have the UK CPI and core CPI plus Fed minutes coming out from us here in the States. It's a big day. We'll react in the Fed's tone and future cuts. But again, it was with less information. On Thursday, China has some items going on with their rate decisions, globally looking at liquidity, which is important. And Friday, we have in the UK, we have retail sales, preliminary PMI here in the US, and we look at some of the consumer and business health going on in Europe. Now, I talk about these overseas items because they enter into what we're doing here. But what really matters is we're looking at the strong CPI or hawkish Fed commentary that can lift long-term yields, raising mortgage rates. That's a possibility. But not necessarily raising, but lowering the percentage of that December 10th meeting, which means we'll see a little bit of fee moves, perhaps on interest rates. But the other side of it, we could look at better rates depending upon a weaker number. Now, weak PMI and cooling inflation can add some relief to borrowers. So that's sometimes I root for bad news to get good news, right? Sorry. But again, depending upon where we are with clients and all that, it makes sense for those clients to save money. Now, these global data points influence U.S. Rates on a daily basis. And we can look at these market headlines. Sometimes they're out at 5:30 in the morning, our time, here on the West Coast, 7 o'clock, and throughout the day. Sometimes we have midday price changes throughout. So if you have, and I'll say it this way, if you have an FHA loan that you've done over the last couple of years, or a VA loan that you've done over the last couple of years, you need to investigate about a streamlined refinance. Appraisal's not needed. If you've done a conventional loan, perhaps you have PMI, maybe the PMI could go away. Maybe you have some money or a chunk of money that you want to put down and you're thinking about refinancing, but maybe it's just a recasting of your loan. So find out if that's possible. We can discuss it. 888-543-3980. That's 888-543-3980. I said a little bit earlier, the Fed possibility right now, quarter point to the discount. on December 10th is about 40.8%. So that's down. I've been kind of watching it. It went down to 30 some odd at the end of the week, and then it went back up a little. So it's kind of bouncing around as the government shutdown ended. But we were up in the 80s, and then, oh, gee, everyone was worried when it was in the 60s. Then it got to the 50s, and oh boy, now there's a 4 and even a 3 at times. So we're watching this very carefully. But it really hinges upon all these items that I just mentioned coming out, and we're watching these things very carefully. And we're watching the fog that may be lifted and allow a better and more clear decision to be made. But we're kind of looking at this. I mean, the 2025 housing trend. I mean, we're looking at this picture of the buyer. The median age of a homeowner right now is 42, while the average is about 44. So, we're looking at this with the Gen X and millennials, and we're looking at what one out of every 5 buyers are under 30, and another 1 in 5 right now are 60 and older. So my generation now. So we're looking at this diverse group of homeowners and buyers, and it isn't just the first-time home buyer market, but a downsizing of boomers. It's really both at the same time. So we're watching this and trying to market that accordingly. But this week, the weekend on the 13th, we looked at the average interest rate was 6.24%, but that doesn't mean that's your rate. Your rate could be better. Now, the previous week, it's up 0.02. So really kind of not major move this week. I mean, change year over year. I mean, last year it was 6.78. So that's a change of good change, 0.54. Now, the 10-year Treasury a year ago was up at 470 back on November 8th of 24. And we're sitting here at the close on Friday at 4.148. So we're 0.552 lower. So rates are better, not by a lot, but we're looking at maybe slightly better as we end to the end of the year. And that economic data that we didn't get is now going to flood in, and we'll reevaluate. We'll talk about it next week and the weeks to come as we head out of the Thanksgiving timeline. But these decisions are important. And later in the program, we're going to dive into the Money Max program, a perfect financial GPS that allows you to make better decisions with perfect information, just like you're doing as you're driving right now. You may not be on that GPS at the current time, but you kind of have fun with it sometimes. You plug it in and you kind of see the route, especially when you're concerned about traffic and deadlines and time. I mean, if you have to get out to downtown LA and you're driving in from Ventura, Santa Barbara, or you're coming from the Inland Empire, and you want to make sure you're getting there and you got a lot of veins to go drive through. You want to make sure what traffic and what accidents and what's occurring, and even the weather. You want to make sure your time is right. So you consult this, and sometimes it gives you a way that you wouldn't have thought of. But it sure beats driving down a 2-lane highway 50 miles, and on mile 46, the bridge is out and you have to make a U-turn. Now, you made that U-turn, you're mad for about 4 miles before you start waving at the people, trying to let them know the bridge was out. And it makes you realize all these people were waving to you and you just thought they were friendly. They were trying to tell you something, but you didn't have great communication. This allows that communication to exist, and you get that information prior to having been a problem, and you can pivot and make a better decision. It's understanding the break of the green and reading the green so you can get into the hole much more efficiently, and you have the inside track. You don't have to be the oh my gosh caddy or professional who can read the grains, because you have that on your team. Perfect information that you don't have to worry about. And just because you get it right one month doesn't mean you have to perform surgery the next month and hope and pray. So this is what I'm hoping to accomplish. And part of that is what Marisha's going to talk about in our next segment. She's going to help us with Family Security Law Group and kind of translate some of the items of why people hesitate and why people don't go forward. But I'll let her discuss that. But interest rate versus interest volume is so very important when it comes to financial decisions. But most people look at a number. They don't look at what's attached to the term or how it's being amortized or simple interest and how it's being paid back. We talked about that 50-year mortgage. It's pretty darn close to just interest only, right? So you have to responsibly look about the principal. Is your home appreciating? In what market? What monies do you need today, perhaps to get your family started? Perhaps on the downside, as you do a reverse mortgage, you can actually have optional payments, not much different, perhaps, maybe just a little bit more because you have a payment, but you're paying down the balance, but not just as quick. And you're paying the interest, so you're loaded up. So that's where we look at this Money Max account. But maybe you're saving for college, or the kids are in college and you need a break for 3, 4, 5, I'm sorry, 7 years, 7-year plan for college, not good. But you have these plans that you need the funds available. And then maybe you're able to then button it up and change the loan at a later date. But we need to make sure you preserve your credit eligibility and all the other variables to make sure that plan you can put into action. And that's what we need to discuss. Now, I mentioned it a little bit earlier, but I'm looking at nearly 90% right now nationwide are perhaps underwater on their mortgage. A lot of people did FHA, VA loans, 3.5% down with a silent second, or 0% down on a VA. And we're looking at a situation where they don't have equity. But as said earlier, an FHA streamline, a VA interest rate reduction refinance, they are available without an appraisal. So we're gaining an ability to lower payments to gain more discretionary to pay off more debt. If you have an FHA, VA loan, I need to hear from you. 888-543-3980. That's 888-543-3980. We're getting people pre-approved heading into 2026, making sure their 2025 returns are going to be set up correctly for pre-approval. We're making sure you're saving your year-end pay stubs. Go back, get your 24 or even 23, but I need or want you to save your 25 year-end pay stub when you get it. Reason why. It has a breakdown of your income, overtime and bonus, sick and vacation pay, all of that. When we use a verification process now, they charge. So they charge us a lot of money to gain that ability. And then generally they're not broken down. So we're really in a bind. Just like the same way when we deal with some HOAs on homeowner associations that have you go to various sites to pull information, but it's not answering the questions we need to make sure it retains approval with the agencies of lending. So we're sitting here battling technology to gain the right information, because junk in, junk out. If it's not loaded in, I don't have it. If it's not broken down, I need it. So we need you the way it has been way previous, as I started in the 80s. We need that last pay stub to break it down. If you've bought property or sold property in the calendar year 25, and we're not going to be in time to, of course, to get a return, I need to know what sold, what was bought. I need to see the movement, the gross, where it went, the deposits. All these things matter because your tenants, the income, and what you have in your holdings matter. So if you move property, very important. I want to be able to use the income I can. I want to have the add backs or depreciation, one-time improvements, all the things that matter. I also have an underwriting background. I don't keep your loan, but we will close the loan majority in our company name, and then I'll have it go out for servicing. I'm very particular about that, but I want to make sure your loan is clear, clean, concise, and we have no hiccups. So when we get approval, we have little to no conditions because we anticipated them, just like I'm talking to you about anticipating your monthly expenses. Now, I'm Mike Harris. You're listening to Your Real Estate Life. Join us for our next segment where we have Marisha Charbonnet. We'll have more after the break.
Looking for a place to start? United for Loans is the place for you to start your refinance or purchase process today. Call crippling 5433-980.
Yes, it's a little scary right now. It's an opportunity. How many times have you looked back and said, why didn't I act? You're not planning to get abandoned without a match. Tune in at 7 a.m. and here at 1 a.m. with hosting CEO Mike Harris of United Mortgage Corporation of America to discuss your real estate life. What should I do? Buy, refinance, sell, or rent? United Mortgage Corporation of America is open for business and ready to lend. Visit UnitedForLoans.com or call 888-543-3980.
Lending can be a bit confusing. Numbers can be tossed from one direction to another. How can you make it all stop? United Mortgage Corporation of America, UnitedForLoans.com can be your guide. Call directly at 888-5433-980 for what you need to know when financing a home of your dreams or commercial property. Call now at 888-5433-980 or visit at UnitedForLoans.com. That's 888-5433-980. I've been laid up and work my business. It's only brand new.
Welcome back to Your Real Estate Life. Let's talk about the true cost of money, not just the rate, but the volume of interest you pay over time. But first, we're going to go to Marisha Charbonnet. She's been waiting to standing by with Family Security Law Group. Marisha, join us today and discuss what the hesitancy is when it comes to an estate plan.
Thank you for having me on the show. You always do an excellent job of reminding listeners about the importance of creating an estate plan to protect their assets and income. I often find that one of the biggest roadblocks to people setting up a will or trust is simply making a decision about who to name as the executor or successor trustee. Practically speaking, those roles are virtually identical. The executor is the person put in charge of administering and distributing assets left in the will, and the successor trustee is the person who is in charge of administering and distributing assets left in a trust. That said, this person is being given enormous responsibility, so it's important to ensure that you have the right individual named for the job. One of the biggest mistakes I see people make is naming someone as executor or successor trustee out of a misplaced sense of obligation. Many people are under the impression that you have to name a family member in this role. That often causes parents to name their kids. While a child may be a perfectly appropriate candidate, it is important to understand that there is no legal requirement to name a child, and a child may not be the best choice if that child is financially irresponsible or strapped for time due to a family or career, or perhaps that child is simply too young or doesn't have the life experience to be equipped to make the choices they will face. Another common mistake parents make is naming their children as co-trustees. This is often done with good intentions. Parents want to avoid hurt feelings or an appearance of favoritism by naming only one child. They often think that naming multiple kids together will solve that issue. It often only complicates things. Not only can it create problems that require court involvement when the kids can't agree, but even where all the kids get along, problems often arise when banks or other financial institutions refuse to deal with co-trustees because they don't want the liability of dealing with more than one person. If co-trustees is something that is really important to you, it's always a good idea to check with your banks to make sure that they will be willing to work with co-trustees. Finally, when naming a child as a trustee or executor, bear in mind the child's age. If your child is a minor when called to act, the court will not honor the appointment. And while the court will allow an 18-year-old to serve, is that really a good idea? If you are naming your minor child because your expectation is that they will be an adult when the time comes, you may want to instead designate your child with the requirement that they must be a certain age in order to act, and have a backup person designated in case you pass away unexpectedly and the child is under the specified age at the time of your death. These are just a few of many important considerations when picking a trustee or executor. For more information on trusts and estate planning in general, I can be reached at 805-496-4681 or at FamilySecurityLawGroup.com.
Thank you so much, Marisha. Such important information for homeowners and families who want to protect what they've worked hard for. And making the right decision is important, but first, one needs to be made. And as somebody who's been named as such, and it is a co-situation with a blended family of sort, and it's very important. And you have different times and ages, and this, it could be awfully. It could be an adventure. We'll say it at that. Make sure you're planning that accordingly. Seek out Marisha Charbonnet at FamilySecurityLawGroup.com. I have a trust, and she's evaluated that trust. Always important to have that re-looked at and updated as things change. Ages change, guardianship changes, All these things have changes over time. Make sure you are up to date. Now, on today's program, we've been addressing the 50-year mortgage, repercussions of that, and how they come along. But again, it's not in your alley. It's not in your alley. It's just another tool. You're not using an ITIN loan, perhaps. You're not using a non-QM loan for DSCR for investment property. You're not using a hard money loan or a private loan. So people have problems with those, but it's not something you're using. If it's something you need to utilize, it's a tool. It's an item that's available. But it's not, oh my gosh, everyone. Well, no. It's when it makes sense, because you're going to spend so much extra on interest over the life of the loan because you extended the term. But the interest rate will be higher than that of a 30-year loan. So it's an interest rate decision as well as an interest volume decision, but it's parking your principal reduction for a period of time where you need perhaps some of the freed up money, 100, 200, whatever it is, 300, maybe even higher, that you can utilize it to handle something over a shorter period of time. I mean, I'll just throw a simple example. Bad example, I guess, because car payments are no longer $200, $300, $400. They're probably $600, $700, $800, $1,000. But if you need to free up some monthly monies in order to handle that 5-year item, this can be that tool in order to then free up that and then look at market trends and maybe redo that loan and shave 50 years down to 30 years in the future. So it is a financial planning instrument. It's not for everyone, so don't fret, don't worry. But interest volume matters. Whether you have a 30-year loan, a 20-year loan, or even a 15-year loan. My goal is to bring down your payment a third or half the time, or not your payment, but all your debt, a third or half the time without changing your lifestyle. As little as that, even 5 to 7 years in some cases. So join me on Tuesday evening at 6 p.m. First person says, I can't be there. Okay, I heard you. I really did. But if you send me an email, interest@aheadformoney.com, I'm going to send you a link to gain access. But I'm also going to send you an item to watch, understand it more, and then separately you can send the Calendly update to me, and let's get on calendar, whether we're on the phone initially or on screen. Because this is really about you and your numbers. It's not about just learning what it is and doesn't apply to you. We will look to budget and understand your ins, your outs, your monthly, quarterly, semi-annual, and annual items. We will do that because we want to be accurate. And we're going to come up with a debt analysis and a debt-free date, and you're going to be shocked. I've had people cry. I've had people fall off the chair. I've had people say, oh, I can't believe this, until I show them even mine. I was taking 26.4 years, and I know my stuff. I was taking it down to 12.2. 12.2, 12.3, right in that range. Under the program, it took me down to 7.9 years. Doesn't sound sexy, but over 4 years, that was 6 figures. I would say 6 figures all the time. Why wouldn't you consider even 20, 50, 100,000? My gosh. Let's talk. 888-543-3980. That's 888-543-3980. We are looking to set up your destination of loan payoff, paying off all your debts and gaining financial freedom. The GPS program, it calculates the fastest, most efficient route based on your income, debts, and spending. And it does account then for variables and updates and items that are then inputted as they come along. It adjusts automatically. I mean, just like you're in the traffic, it adjusts. It adjusts with the financial traffic. Pay raises, bonuses, added expenses. It takes all of that into account. It helps monitor and redirect excess cash flow and minimize interest volume, every penny, saving you time and money on your journey. Now, you don't need to have an equity line or insurance or all these other things that could enhance the item depending on where you are in your life, but it takes only a checking and savings. Only a checking and savings. Give you an example. Jane, let's say, chooses a 30-year loan, but adds $200 a month to the principal. Now, her Money Max program is knocking off about nearly 6 years and saves $95,000 in interest. Now, you can throw darts and we can give it a shot. But John with a 50-year mortgage can do the same. And then he's looking at lump sums. But then we also want to look at that interest volume. Now, we're going to have another segment to go. Lots of numbers, lots of confusing stuff, but I'm here to help simplify it. I'm Mike Harris. We'll have more after the break.
Get pre-approved for your home purchase. Your landlord loves you. You're making their mortgage payment. Own for less than you pay for rent. Call 888-5433-980.
What if I told you everything you understood to be true about money is not? If there was a program to eliminate most of your interest in your life and pay off all your debts, personal or business, even mortgages, in as little as 1/3 to 1/2 the normal time without refinancing and without changing your lifestyle, would you want to learn more? Call 888-543-3980 and request your information today, or email at interest@aheadformoney.com. That's interest@aheadformoney.com.
Money, money, money. Must be funny in a rich man's world.
Welcome back to Your Real Estate Life. It's your day in real estate radio. I'm Michael Harris, mortgage loan originator 233410 with United Mortgage Corporation of America, NMLS 3189. Now, you can reach me directly at 888-543-3980. That's 888-543-3980. You can talk to me about lending, purchase, refinance, different programs, where you are, see if there's something better. If it's not, I'll tell you. We can look at planning. We can look at your current budgeting. Now, if you didn't do your mortgage with me, that's okay. I'm never too busy to work or speak with you. I want to get you on the right path, whether it's refinancing in the future or whether it's just utilizing, I say just, but utilizing the Money Max account to pay off debt sooner, maybe creating opportunity for you and your family. I want to make sure that you utilize this properly. Now, professionals out there, we have other mortgage loan originators. We have CPAs, tax professionals who prepare returns. We have insurance, financial planners. We have divorce attorneys out there, and others who can help their clients achieve more by freeing up discretionary by eliminating interest volume. I talk to a series of professionals all the time who instigate and utilize this as part of a tool for their clients. Now, if you have a loan right now and you don't know about this, why? Refer your mortgage loan originator. I'd love to have a conversation so they don't leave this out as part of their plan. Because if you have a good relationship with your mortgage loan originator, I'm not asking you to change it. I just want you to make sure that you're effectively getting the information you need. And if I could be an issue or help to that, great. I'm talking to people all over the United States, and I'm gaining people who are helping others in states that I don't even lend in. Now, as United Mortgage Corporation of America, we could do mortgage loans on the purchase, refinance, forward or reverse in 5 states: California, Colorado, Montana, Texas, and the state of Washington. We do investment loans, DSCR loans. I do those in 46 different states. So mind you, I probably cover it. If I don't, I have a network of individuals that I can refer that I trust, that you can trust to go forward, and you make your own decision. So I'd love to hear from you regardless of where you're looking to get financing, and I can help guide you in that way. I've been doing lending for 38 years plus, and I want to be of help and service to you. Now, I was kind of looking at the calendar, and today, again, we covered 50-year mortgages, where it really helps those it needs to help, but everyone is egging onto it like we didn't pay that much attention to some of these other programs. It's going to be an audience, but not everyone. We talked about the economic calendar for the week and the data that's still driving interest rates coming in from past data now that's coming to fruition. We did discuss the interest volume, interest rate item quite a bit. And we had Marisha who joined us about estate planning and protecting your family and choosing and having that person and having that discussion so you can move forward. But we did have some comments and some questions I want to address. But you can call us at any time, 888-543-3980. Email me directly, interest@aheadformoney.com to join our webinar on Tuesday evening. No strings attached, good information. But when you email me, I'm going to send you back kind of a summary to watch, but also a few other links that you can watch and gain information, maybe even schedule a time with me before or after the Tuesday night. If you're a professional, I'd like to talk to you about joining me on Thursday evening at 6 p.m. showing you how you be able to maybe enhance your past database or work with your current clients. So first question I see, would you consider a 50-year mortgage if it helped you qualify for your dream home? Well, we addressed that. Some people, you're off just barely, but you have the right everything else. And sometimes freeing up that 100, 200, 300, 400 a month would be the difference of getting your debt to income ratios there. It's important to consider the unknown factors, the items that you're going to see when you get into your home, various expenses, making sure you allocate for insurance and everything else that occurs to make sure you're not too tight. And that's where that GPS program comes into play as well. So for some listeners, yes, gives you that ability to get in. But for some others, no, because the interest cost is too much and you don't have a plan. So we need to really take a look at that. And of course, I would want to know what you think after you hear those options. Now, another one says, if you had an extra $200 per month, would you invest it or apply it to the mortgage principal? Now, consistency means something. A 200, sometimes the lender's just going to hold on to it and wait for your next payment. So whether it's applied to your principal, you want to make sure that occurs and it's not just being held in a side account. It happens. So very important that you understand the rules of the game before you play them. But just throwing a random 200, it may or may not make too much of a difference to your overall state. Now, if you're trying to do it consistently, I like you to do it better to the penny as to reason why. And that's having a conversation. We could look at budgeting and how that comes about. Also, if you have that 200, and let's say I'm saying 20,000, you want to look about, is your rate good or best that you have now? And maybe lowering your payment by getting a recast of loan and costing maybe $300 can lower your payment. And then we can use that difference to pay off other debt. So there's a lot of financial planning that's involved to that comment or question. And I'd love to talk to you more. 888-543-3980. On other shows, I've addressed this, and I want to address it again. How can I utilize a reverse mortgage or home equity line of credit, HELOC, for debt management? What's the difference? Well, long question there for answer. But a reverse mortgage is ideal for retirees managing fixed incomes, reducing monthly payment obligations, or replacing high interest debt while aging in place. And it's can come as a first or even now as a second. There's reverse mortgage seconds that you can do. And it gives payment flexibility because it's not required. Now, a HELOC, a home equity line of credit, requires a monthly payment. I mean, it's great in the sense that you have it available to handle fluctuations in various items that are needed with income and payoff and short-term borrowing. Gaining a HELOC is so very important when you have equity and you don't need it, because when you need it, you can't go get it. So I have a lot of my listeners, a lot of my past clients gaining a home equity line of credit. So this way it's there and it's available to them to write the check, transfer the money as needed. And it's been going down with the prime now going down, which is at 7. If we get another move, it goes down about a quarter at a time at the present moves. And we can see you saving money. But if you're not using a home equity line of credit and you have a first mortgage, I'd love to show you how to utilize that simple interest to pay down amortized interest and eliminate months and even years off your loan, because rates are different. The term in which they're paid makes the gig. So that 3% mortgage is not better than the 7% home equity line. I'd like to show you how that works. 888-543-3980. Looking at maybe one last question here. How do you view your home? As a place to live, an investment, or both? Okay. Well, little thought to that one. Now, in thought, it is a place to live. But over time, you've gained equity. Right now, we're back to that point where it's a place to live. You do look at some of the tax advantages, if so, and you balance those out versus renting versus buying. You're looking at how high rents are, and are you getting anything for that rent versus ownership, and maybe balancing it out. Now, if you look over history, there may have been 3 times over a 5-year span that values were down. So what goes down goes back up. What comes up must come down. And not necessarily, it may bounce back up. So we want to look at that based upon timelines and what you're looking to accomplish, as if that makes sense. We have some that will buy a property, low down payment, get in. It'll be their startup property, turn it into an investment, move on to another based on job, income, and expansion. So that makes a difference. So the idea of both probably makes sense to keep your eyes open, but sometimes it starts as one to lead to the other. And having that sight of your family growing, needing more space, those things come into play. Now, investment properties aren't for everyone. Some people don't want that complication. They don't need the management company or trying to handle it themselves. They will go ahead and make that decision. That's not for them. I'm working with a client right now who is looking to sell their existing to buy another, but it might overlap a little bit. Now we're able to gain the qualification as such that we can do that, but the goal is not to have two mortgage payments. The goal is to have the one, and then once he sells that other property, he's going to have some proceeds. Those proceeds will then pay down the new loan, and we're going to do a recast to gain a lower monthly payment. So again, it's part of the budgeting and planning. Now, we featured a lot of things on today's program. And our program here is Your Real Estate Life, and it is on YouTube as well. And you can catch it there as well as on our websites and listen to the audio or give us a call directly. Now, our website, yourrealestatelife.com or unitedforloans.com. Our YouTube site, Your Real Estate Life, or call us, 888-543-3980. But the big takeaway today, it's payment relief with ultra long terms, but don't let that long-term cost of interest be at your demise. It's making sure you know when to make that churn off the freeway. Gain the advantages until you don't need them before they're not an advantage any longer. And that's what we'll go through. We looked at economic reports and the items that are coming out and some of the delayed items and how it affects interest rates. I mentioned that every single day interest rates go up and down, sometimes multiple times during the day. So we kind of keep an eye on that. I mentioned about the importance of budgeting, and I have a one-page budget sheet. I'm happy to send it to you. You can email me directly, interest@aheadformoney.com, aheadformoney.com. And with that, I'd like to send you the invite to Tuesday evening at 6 p.m. It's a 1-hour webinar. No reason for you not to attend. No reason. But if you can't, I want to give you access also to a partial presentation and some additional information. And I want to know what you think about it. I'd love to set a time before or even after that Tuesday night to talk with you. Now, I know the holidays are coming up. I want to be convenient for you. Let me know what works for you. I want you to have full access for your financial planning and what you're doing for your budget when we look to eliminate your debt. 888-543-3980. That's 888-543-3980. Now, I hope you got a lot out of today's program. We covered a bit, but not as much as we could. Now, I don't want to give you a fire hydrant of information, but know that it's available, and I'm willing to discuss your particulars with you. Now, if I just turned on this off the spigot and shouted it all out, oh my gosh, every one of you are different. I want to know your real estate life and your story. Pick up the phone, 888-543-3980. I want you to be informed. I want you to stay strategic. I want to keep you up your financial GPS on course, but you need to start. And today's about getting started. Don't have much of the year left. I want your 26 to set up right. When we're closing loans here in November, the first payment is January 1st. I want to make sure you keep in mind that you got your property tax payment. If you have impounds, make sure your statement is being dispersed this month so it's not late by December 10th. If you're paying it on your own, make sure you got it automatically being sent or it's postmarked or whatnot by December 10th. Make sure you're on time there. And start planning your year-end items. Is income higher? Is it lower? Do you push deductions or you're taking them? These are important concepts to talk to your tax preparer or CPA about. We have individuals that are doing items on investment property and movement. We have ones that are setting up equity lines to be prepared for items that will come up temporarily so they can pay them before money is coming back, or items are on delay. It's all about money and moving it properly. And it's not, well, I think so, I hope so. Well, let me check the yellow sticky or the pink one over here. That's going to catch up with you. Let's make the focus right and perfect and make sure your goals are met and handled so much easier. 888-543-3980. That's 888-543-3980. You know, I was looking at some of the statistics of some of my realtors that I work with on a regular basis, and we're seeing a lot of the competitors that they have, their properties are being delisted or lowering in price. It's because they were listed incorrectly, and I've talked about that before. Now, I'm licensed as a broker. I don't list, I don't sell. I can't pretend to do the 162 things the realtor does. But if you're listing your property, you have an idea what it's worth. As a lender, we have a lender accepted number that we look at as what would be acceptable if we had an appraisal waiver. It's so very important to talk to your professionals and your team to gain the realistic number where you know it should be, not what you hope or think it should be, where when you're saying, hey, I listed my property at, and you think that is your number. You need to understand what negotiations may exist, what closing costs you may have to cover, and other items to get a realistic result. Take the time to consult with professionals. You think hiring a professional is expensive? You try hiring an amateur. You see how that works out for you. You may get a short-term fix, but until you have a long-term problem. I don't want that for you. I look to minimize costs and get the job done. Been doing it for 38 plus years, and I want to give you that insight and direction and guide you through the process. I'm Mike Harris, loan originator 233410, United Mortgage Corporation of America, NMLS 3189. I hope you enjoyed today's program. I thank you for joining me. I thank you for taking the time to listen on this weekend with a lot of things going on. You got people enjoying concerts, football, all these fun things, basketball, hockey, all these things to distract you. But I want to keep you on course so you can enjoy those items that are important to you. And right now, it's a family time. For some, and for others, it's about putting your stuff together correctly. Plan. Now, we'll be back next Saturday with more insights, market updates, and listener questions. Until then, spend smart, borrow wise, build equity, and keep your financial GPS locked on your destination, homeownership, and create wealth. I'm Mike Harris. Thanks for tuning in as we explore the market options, and strategies for the money, and you work harder. What kind of loan do you have?
Mortgage Corporation of America, UnitedForLoans.com will continue to take your calls after the program. Call now to start your home loan process at 888-5433-980.
Thank you so much for joining me this weekend. You know, I have some family plans going on, so busy times, making sure everyone's happy. And if they're happy, I'm happy. So we have some outings to do this week. We're watching some fun college football and some other items on our calendar. With that said, I'm working on some closings next week, and I'm working on some new applications with some new purchases. Give us a call, 888-543-3980. Until next week, what kind of loan do you have?